Building wealth is harder than it used to be. Prices are higher, jobs are less stable, and money is moving faster than ever. But you don't need to be rich to start investing. You just need a plan that makes sense for you right where you are. Segment number 1, the wealth equation. Let's start simple because wealth really is simple once you understand the formula. Wealth is not what you earn, it's what you keep, grow, and protect. There are 3 levers that truly build wealth. Number 1 is cash flow. Number 2 are assets. And number 3 is time. Number 1, cash flow. Cash flow is your income minus your expenses. It's the fuel that powers everything, but most people never learn how to control it. Here's a fact. Forbes found that even high-income earners often lived paycheck to paycheck because they haven't built systems for managing their cash flow. It's not an income problem, it's a behavioral problem. That is why the people that understand that wealth is a behavior, they treat every dollar like an employee. Each employee has a job, and yes, they expect a return on their investment. Number 2, assets, which is the engine. Assets are what you own that increase in value over time. Think about stocks, real estate, a business, even intellectual property. Morgan House, the author of The Psychology of Money, says it best. Wealth is what you don't see. It's the dollars you quietly invest while everyone else is showing off their lifestyle. The goal isn't to look rich, is to build assets that work for you while you sleep. And number 3, time, the driver. And the last lever, the most misunderstood lever, time. Time multiplies money through the power of compounding. But here's the catch. It only works for people who start. Every year you wait to invest or to save, you're not just losing dollars, you're losing time in the market. And that's something that no raise or refund can replace. Let's tie it all together. So think of wealth like a vehicle. Your cash flow is your fuel. Your assets is your engine. And time, that's your driver. Most people focus on the fuel, chasing the next paycheck or the next promotion and even the next client. But the smart entrepreneurs, the wealthy people, they design the whole vehicle. And listen, this might sting a little bit, but if your money doesn't have a purpose, it will always find one on its own. And 9 times out of 10, that purpose isn't building your wealth. All right, segment number 2, building from zero. If I had to do it all over again, these are the steps that I would take to help me go from surviving to thriving. Step number 1, stabilize before you scale. You have to build a financial foundation that will hold you up. That starts with an emergency fund. And I'm not talking about a couple of dollars in your savings account. I am talking about at least 3 to 6 months of living expenses tucked away. The fund isn't just for emergencies. It also gives you permission to take risks later. It gives you a peace of mind so when opportunities come, you can say yes without fear. Think of it like this. Your emergency fund is your freedom fund. The stronger your safety net, the bolder the moves you can make. Step number 2, specifically eliminate high interest debt. I know this is not a glamorous topic, but the reality is no investment will ever beat paying off high interest debt. You can't out-invest a 25% credit card rate. So before you play in the market or chase the next big trend like Bitcoin, pay off what's holding you back first, and that's your debt. So you have a couple of options with paying off debt. You could start with the avalanche method that focuses on the highest interest rate first, or you can use the snowball method that will help build momentum. And psychologically, when you see those small wins, you keep going. The goal is progress, not perfection. And if you're interested, I have a debt calculator listed below where you can choose between the snowball method or the avalanche method. But if you want something a little more digital, Rocket Money is a great option. And no, I am not sponsored by Rocket Money. This is something that I use in my daily life, but it does help you keep track of every dollar that you're spending, and it will help you stay consistent. So here, I use it to track my expenses today. So think of it like this. Every dollar you free from debt and redirect into your wealth, it moves you closer to your goals. Step 3, automate your money. Once you have stabilized and started tracking your debt, it is time to put your money on autopilot because consistency builds wealth faster than intensity ever will. So here's what you do. You set up automatic transfers so that you never have to rely on your willpower alone. And here's a simple system. Try the 50-30-20 rule. It's timeless and it gives every dollar a job. So what is the 50-30-20 rule? 50% is for your needs. Think of it as your financial foundation. These are your essentials. It's rent, mortgage, utilities, food, insurance, and even transportation. If this number creeps past 50%, it's a sign that you need to cut or create more income. All right, 30%, think of it as your lifestyle and your enjoyment. This is your permission to enjoy life. So think vacation, dinner with friends, self-care. It all fits here. And remember, wealth building isn't depriving yourself. It's built through discipline. So spend with intention. Last but not least is the 20%. This is for your debt payoff and investment. Think of this as your freedom fund. This last 20% is where your future begins. Use it to pay off high interest debt, although your debt should be paid off at this point. But you can use it to invest into your 401k, a Roth IRA, a traditional IRA, index funds, or even reinvest back into your business. Small, consistent contributions always outperform occasional big contributions. All right, I know I said a lot in that last segment, but this is your takeaway. Automation isn't about laziness. It is about discipline that never forgets. Because if your money moves automatically, you will build wealth, even on the days you're not working. All right, segment number 3, investing basics. Okay, so you're going to ask me, what do I do with the 20%? I know you're talking about investments, which is somewhat confusing to me. So Sabrina, break it down. All right, here you go. Here is the good news. You do not need to be a financial advisor to get started and to understand investing. You just need to understand the categories. And once you know where your money will grow, the fear disappears. All right, let's get started. Category number 1, stocks. This is your growth engine. Stocks are high risk, high reward, but historically, they have delivered some of the strongest returns over time. According to Forbes and Vanguard, the S&P 500 has averaged around 10% annual returns from the last 50 years. So when people say the market always come back, they are not lying. History proves this. And hey, if you're a beginner and you do not know where to start with stocks, skip the stock picking. Focus on a diversified ETF that tracks the market so that you don't have to guess which stock to pick. And what are ETFs? ETFs stand for Exchange Traded Funds. It is an investment fund that holds a mix of assets like stocks, bonds, and commodities, and it trades on the stock market just like a regular stock. So how does it work? When you buy one share of an ETF, you own tiny pieces of every company inside. Moving on to index funds. Index funds is where beginners win and millionaires stay consistent. They grow with the market, not against the market. Warren Buffett actually said a low-cost index fund is the most sensible investment for the majority of people. Why is this? Because they require no guesswork, no stock research, no day trading. You simply buy a small piece of hundreds of top performing companies and letting time do its job. That's it. And listen, index funds, they're kind of boring. In my opinion, boring builds empires. The people who win in investing aren't the smartest. They are the most consistent. So if you've been listening to this and you think index funds sound like ETFs, you're not wrong. The simple difference is that ETFs are traded like stocks, while an index fund is brought directly through an investment company, usually at a set price. Number 3, real estate, the tangible builder. Real estate is one of the oldest wealth building tools in history across the globe. But let's be real, in 2025, not everyone is ready to buy a property. So instead of waiting until you have $100,000 saved, start with REITs. REIT stands for Real Estate Investment Trust. They allow you to earn passive income on commercial and real estate properties without owning them directly. And listen, you start with REITs, and then when you're ready to buy a home, focus on cash flow, not curb appeal. A home that pays you monthly is an asset. A home that drains you monthly is a liability. Let me say it again. You do not need to own the building to receive income from said building. There are many ways to invest in real estate. All right, number 4. Number 4 is near and dear to my heart because it is one of the best tax advantage vehicles you will ever find. And that is retirement accounts. The real secret weapon to long-term wealth. And that is retirement accounts. Retirement accounts, in my eyes, is the real secret weapon to long-term wealth. This includes your 401ks, your traditional IRAs, and your Roth IRAs, okay? Here's the difference. A 401k or some type of retirement account, it is pre-tax, which means it will lower your taxable income. And on the screen, I have the 2025 contribution limits. So if you are under 50, you can contribute up to $23,500. That is as an employee. If you are a business owner, you can contribute the employee portion as well as the employer portion. So now you see why I love retirement accounts. Roth IRAs and traditional IRAs, they're kind of tricky, so let me break it down. A Roth IRA, you contribute after-tax money, but qualified withdrawals in retirement are tax-free. So you're taxed in the beginning and you're not taxed when you pull the money out. Simple, right? A traditional IRA, you may get a tax deduction on contribution, but withdrawals are taxed in retirement. So you get a tax deduction in the beginning, and then in the end, when you're ready to withdraw, you're taxed. Think of these accounts as compounding machines. They don't just grow your money, they protect you from taxes, which is how the wealth stay wealthy. And last but not least, another one that is near and dear to my heart, business ownership. Whether it's your personal brand, a service business, or you just have equity in someone else's company, owning something that produces income without your constant effort is the fastest route to freedom. In fact, according to a 2024 Forbes wealth study, 67% of self-made millionaires built their wealth through business ownership or equity. Business ownership is risky, but remember what Morgan House said in The Psychology of Money. Every financial plan depends on luck, but every financial plan accounts for risk. The goal isn't to avoid risk, it's to manage risk intelligently. If you don't hear anything else, hear this. Think of investing like going to the gym. You don't see results after the first day, but over time, your gym discipline compounds just like your money will. The only difference is that one built your body and the other one builds freedom. All right, last but not least, segment number 4, the 2025 reality check. Let's be honest, 2025 isn't 2015. The economy looks different, the opportunities look different, but the principles of wealth haven't changed. Back in 2015, your safe play was putting money into a savings account and letting interest carry you. But now in 2025, it's about making money work via smart investing, small businesses, tax planning, and leverage. But here's the truth. The biggest risk today isn't losing money, it's standing still. Yes, the world is changing around us, but smart entrepreneurs and wealth builders, they always adapt. If you learn the new rules, you don't just survive, you thrive. If it's one thing that you got from this video, I hope it's this. You do not need to know everything about money to start building wealth. You just need to know your next step. Start by paying off your debt, automate your money, and take that 20% and invest it into something that you do understand. The ultimate goal is that you will give your money a mission. If you're ready to start your financial journey, drop in the comments and let me know which step you are working on. And if you love videos like this, check out my wealth building playlist. It's linked somewhere up in the cards. Thank you for watching. I'm Sabrina Michele. I post weekly strategies to help you build wealth, stay consistent, and finally create financial freedom. Until next time, stay focused and build slowly. Bye.